With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks.
Jerome Powell announcing earlier this week the Fed Reserve's first rate cut since last year. The Federal Reserve lowered rates by a quarter point, the first cut that we have seen since December of last year. So that puts the benchmark federal funds rate in a new target range between 4 and 4.25%, down from the previous level. And officials signal that we could see as many as 2 more cuts before the end of the year if the economic data supports it. Lower borrowing costs could help families with mortgages, car loans, credit cards. But will it be enough to offset inflation? Let's get some perspective now with Sina Golara, Assistant Professor of Supply Chain Management at Georgia State's Robinson College of Business. Welcome to the show.
Hello, thank you very much. Excited to be here.
So is this rate cut more about maybe helping the economy grow or about calming nerves over a slowing job market?
It's generally a reaction to the labor market. Essentially, the Federal Reserve was trying to resist rate cuts because they had a lot of worries about inflation, especially after tariffs. They have repeatedly said that we worry that these tariffs might reignite inflation, and so that could get out of hand. And they were not. They were putting a lot of weight on that, but over time they realized that the labor market is deteriorating, and so it got to a point where it got really worrying for them, and they had to react and reduce their rate.
Yeah, we're just starting to get more data about the impact of tariffs. For everyday people, money's pretty tight for most folks. How quickly might this cut show up in things like mortgages, credit cards, or car loans?
I would say it already has, because the market has been predicting this rate cut right after we got the labor data in the last 2 months. So the 10-year yield has been coming down, which is a benchmark for mortgage rates. If the Fed keeps cutting rates, we should see that trend continue, because that reduces the borrowing cost for banks. Then banks would be able to offer mortgages at cheaper rates, and so that could be one effect. However, we have to be cautious. If inflation surges again, we have to go through a period of mortgage rates going back up temporarily.
Yeah, it's always a balancing act. So on the flip side, if somebody has money to save, what does it mean for people with CDs or high yield savings account? That lower rate could impact that as well.
Yeah, so generally when these rates are dropped, the interest that different institutions pay on cash or other financial assets also slightly goes down, although 25 basis points is not a substantial amount that would affect personal finance decisions by a large amount. However, yes, if keep reducing this rate, the interest on those things may also go down. So then one has to evaluate, do I still want to allocate as much as before to these interest products, or move money around a little bit?
Mm-hmm. I'm sure you always get the question, so what happens next? 2 more rate cuts have been announced between now and the end of the year, but do you see anything which could change that potentially?
Yes. So basically the Fed is trying to balance employment and inflation, right? So if they stimulate the economy too much, that's going to help employment, but then it will also cause a resurgence of inflation. If they don't stimulate enough, the labor market will keep weakening, and that's a very bad outcome for everybody, including the more vulnerable populations. That would be the first people who are impacted. Mm-hmm. So the Fed has to strike this balance, and they look at the data. So they're going to look at the data month after month. If inflation rises again, they'll have to slow down. They will definitely slow down their rate cut path. However, if you get bad employment reports, that would potentially accelerate the plans for the rate cuts.
Yeah, inflation's really what hits people on those everyday items that are essential in our lives. So I'm curious, from your perspective, bottom line, should families and businesses see this as a turning point or maybe starting to turn the corner, or just a cautious first step by the Fed with really a wait and see mentality?
I think this does paint a picture of the Fed changing direction. They have been keeping the rate at a high level by their own analysis. They because of inflation, they went to a level for the rates that they consider to be tight. Now, so they never planned to keep it tight as much as they did. And so they would naturally, the moment they feel more comfortable with inflation, they would naturally want to bring that down. So we are looking at meaningful reduction of the rate. The Fed governor's own prediction on the Summary of Economic Projection report also shows they're planning several rate cuts in the future. And so if we don't get a surprise on inflation, they should be slowly reducing this rates to more neutral level. And the neutral level is not something they're very clear on, but they basically, again, look at the balance of the labor and inflation.
Yeah.
And so that's the plan, but it all depends because the economy is very dynamic.
Sure.
We still haven't seen everything we should have seen about tariffs. Tariffs have caused less inflation effects, fortunately, than predicted, but we are yet to see the end of it.
Yeah, we'll see what happens next. There's so much to consider, and I know it's always changing. Sina, Golara, thanks so much. We always appreciate your insight.